Welcome back. Bill Gross is manager of the world's biggest bond fund at Pacific Investment Management, Pimco, and he grabs some attention today after saying that the systemic risk of new asset bubbles is rising, with the Federal Reserve keeping interest rates at record lows. He joins us now from Newport Beach, California. So, Bill, great to have you back with us. You talk about the systemic risk. I mean, how much further do we have before the Fed has to start doing something when it comes to interest rates?
Well, the point I made, Carol, was that the Fed was becoming sensitized to the potential. I mean, we've had speeches by Cohn and Bernanke and Evans in the last week, and it's obvious that that they felt it necessary to speak to the potential down the road for asset bubbles and what they might do within that context. Actually, they suggested that monetary policy wasn't the appropriate tool to use, and that regulatory means and measures would probably be the way to go. So in terms of monetary policy and the current 0% interest rate, I suspect there's nothing to be done. And if anything, the bubble that's most apparent on a global basis is not really the gold price, but what's occurring in the Chinese economy. So the Chinese, I suspect, at some point will have a bubble of their own to confront, but it's probably not here in the United States through monetary policy.
Do you expect, I mean, we heard yesterday from Jim Bullard saying that it could be 2012 before the Fed finally raises rates, and you make the point that with so many millions of people unemployed, you'd have to be crazy to think that they do it until they work that unemployment number down a little bit. Do you think we could wait that long before we see monetary policy increased?
Well, I think Jim Bullard from St. Louis was taken a little out of context. He suggested that if the Fed played according to a normal playbook, which would mean relative to unemployment and relative to the ultimate low in Fed funds, which occurred 6 to 9 months ago, that it would be several years in 2012 until they started to raise rates. I don't think he was really making that as a forecast, and I think those that hinge their particular yield curve strategies on it probably shouldn't. But I do think that, yes, with unemployment in double digits and likely to stay close to that for the next 6 to 12 months, despite job creation ahead, that the Fed has nowhere to go in terms of an upward plane, and that they stay exactly where they are.
Is there any reason to think that we can actually work unemployment down to below 10 months in 6 to 12 months? I mean, after the 81, 82 recession, it took a full year and we got to almost 11. Why would we be able to decrease that number faster now?
Well, I don't think that the chances are high, or even above 50%, that can be done in a significant way, maybe by a tick or two, but to lower unemployment because of growth in the job force really requires 250,000 or 225,000 jobs per month in terms of creation. Can that occur? I suppose it can, and I suppose it will during selective months in 2010, but not really in terms of a significant trend, because there's been not only job destruction, but models of job destruction in autos and finance, in other industries that probably will never come back to the level that they experienced several years ago. And so I think unemployment is here to stay.
Bill, let me ask you, though, about the recent economic news we've had as of late. We've seen some soft economic data and kind of, bringing doubt into the kind of recovery or any kind of robust recovery. I mean, are these the kind of surprises that define the new normal for 2010 and 2011?
Well, I think so, if only, Carol, because the V, which has become the rage in the past month or two, was dependent upon significant increases in growth, and not 4 or 5 or 6% real. I think we had a decent quarter if it in fact remains at a plus 3% in terms of the revisions. But the V opportunists, or the V enthusiasts, I guess, were dependent upon job creation relatively quickly. They were dependent upon corporate investment relatively quickly, and I think we're beginning to see that those two significant factors probably will await a significant point sometime deep into 2010.